Buying a home or car, it's about to get even more expensive.
They're on the warpath, aggressively raising rates.
But there are ways you can benefit from another interest rate hike.
The FDA is warning not to cook chicken in NyQuil. Seriously? Do people need to be told that? We investigate if anyone's really doing it.
And refugees from Ukraine headed to Greensboro.
Finding yourself in a different environment is really difficult.
Let's dig into it.
These days, with inflation so high,
give me some of that.
Here you go. We are all trying to stretch that money as far as we can.
Yeah, but the money can only go so far, and then we all feel, the pinch for sure.
Good evening, I'm Ben Briscoe.
And I'm Tanya Rivera.
And this is why the Federal Reserve is stepping in and raising interest rates one more time.
We're going to dig into all the ways that higher interest rates will impact your wallet.
The Federal Reserve is at the center of the fight to bring down inflation. Overall, prices for just about everything have gone up 8.3% in the past year. Groceries spiked at more than 13%. Electricity, almost 16%. Rent, nearly 7%. So in the hopes of helping to bring down prices, central bankers are raising interest rates by 0.75 of a percentage point, the fifth rate hike this year.
They're on the warpath, aggressively raising rates.
President Biden can't tame inflation, but he told 60 Minutes he's optimistic about getting it under control.
We hope we can have what they say, a soft landing, a transition to a place where we don't lose the gains that I ran to make in the first place.
That soft landing involves bringing prices down without sparking such a big slowdown that the economy then slips into a recession. And the rate hikes will have other direct impacts on Americans when it comes to borrowing. The average credit card interest rate is already at an all-time high of more than 18%, but it could go even higher. And when it comes to buying a home, rate hikes have helped push a 30-year fixed mortgage above 6%. That is more than double from a year ago, and it's the highest in 14 years. Economist Mark Zandi says odds of a recession are 50-50.
If we get a little bit of luck, we don't get hit with another shock, and we get some reasonably good policy making by the Fed, we should be able to make it through. But those are a lot of ifs.
Okay, so the rate hike will hit you one way or another. But experts say there are 4 steps you can take to help make the best of it. The first place you're going to see your interest rates rise is your credit card. Call now and ask for a lower interest rate.
The credit card company's not going to call you and offer you a lower rate.
About 3/4 of the time, if you ask for a break, you can get it from your credit card company.
Number 2, consider transferring your balance to a credit card with a 0% introductory rate. But pay off the balance by the time the special rate ends.
Be careful with some of the introductory rates because as those go away, you can actually, if you don't pay off that balance, you may get hit with that higher interest rate.
3, improve your credit score. The higher your credit score, the more likely you'll qualify for a lower interest rate on loans. Credit scores can take time to improve, so start now. Go to annualcreditreport.com to get a free copy of your report. Make sure there's no mistakes.
People do make mistakes. Companies make mistakes. And so you may see something on there that wasn't your fault and you can dispute that.
Higher interest rates can also be a benefit. Saved money will earn more money without you doing any extra work. So number 4, shop around for a high interest savings account. Look online for the best rates.
Well, there is one way to drastically improve your credit score, and fast. You have to lower what % of your credit cards you're using when carrying a balance. It's called your credit utilization rate. Now, to get a better credit score, you want to keep your balance at less than 30% of your total credit. So if your card's limit is $1,000, you want to use no more than $333 of that money. Now, recently, someone also said this to me. To build credit and increase your score, you should pay off the majority of your balance, but keep just $1 on there from month to month. Well, that is a myth, and here's why.
It's actually a quite common myth. Your credit card balance is what you owe. So owing nothing is better than owing something, even if it is only $1.
It is a myth for sure. Don't leave a small balance thinking you're doing yourself any favors. Also, make sure to make all of your payments on time, all of them. Even one slip up can have major consequences.
Those payments on time, in full if possible, those are the things that are being reported that are going to do good for your credit scores. A single late payment can remain in your credit reports for up to 7 years. So that's the last thing you want to have is a late payment on.
It's as much bad luck as breaking a mirror. So far, the stock market has been a mixed bag in response to the Fed's interest rate hike, but experts say some companies will fare much better than others when rates are raised.
There's certain kind of stocks that get clobbered when interest rates go up, and certain ones don't. And the ones that get clobbered are growth stocks.
Okay, so what's a growth stock? That is any company that has done better than average gains in recent years. If you have a bunch of those growth stocks in your portfolio and you saw your holdings drop in value, you might panic. Financial analysts say breathe and think before you do anything.
For those who are nearing retirement, before you pull the plug, before you panic, think of this. Even if you were 62 years old and you said, I want to retire in 2 years and I'm really scared, I would suggest that you're not going to pull all of your money out of an account today because you need your money to grow. And we don't know when the recovery is going to come.
In fact, if you're younger, it might be a good time to buy stocks after they fall in price.
And you're contributing regularly to a retirement account, this is an opportunity for you actually to get more bang for the buck, perhaps, as long as long-term that stock market's going to be a place that's going to continue to rise and benefit you longer term.
While stocks are mixed, economists say higher interest rates make the dollar stronger. In fact, today, the dollar is near its highest level in more than 2 decades against all the other major currencies. So what does that mean? Right now might be the time to travel internationally. Consider the Japanese yen, for example. A year ago, $1 could get a little less than 110 yen. Now it can buy 143. That's about 30% more. Even if you're staying here at home, the strong dollar helps the cost of importing goods be lower. The major downside to a strong dollar, the United States companies that sell overseas. Most currency experts expect the dollar to stay high, at least for a while.